All right, well, let's get started here. Thank you for joining us, everyone. My name is Jason Dahl. I am a certified financial planner and the Director of Financial Planning Services at AFS Financial Group. With me today, remotely still, is my colleague and the delightful Alp Adebeck. Alp is the founder and managing partner of AFS. I know we have a lot of folks tuning in from the 401k side, as we like to refer to it. So just as a quick reminder, so we at AFS Financial Group operate as a separate entity from the AFS 401k Retirement Services team, but we often collaborate, especially when it comes to our financial wellness programs and workshops and webinars, just like this. So thanks for joining us. Today is going to be our last session for this year's monthly workshop series. It's been another great and stellar year of educational sessions filled with great audiences just like yourselves, and we are very much looking forward to kicking off our 2022 series in January with a market and economic recap of 2021 and, of course, an outlook for 2022. Lastly, for today's session, please ask questions at any time. You can ask a question, as I mentioned a moment ago, by typing it into the Q&A or the chat box. The Q&A I seem to find a little bit easier to use, but either one works just fine. We will keep our eyes out to address those questions. So don't think you need to wait to any particular time in the presentation to ask a question. And if anything pops into your head, feel free to type it in there. We may reserve the right to hold off addressing it right at that moment if we know, hey, we're going to cover that subject later in the presentation. Probably my favorite question is, can I schedule a time to speak with you directly, Jason and Alp? And I want to encourage you to please directly follow up with us after the webinar if you have further questions or would like to schedule a time to review a few things over Zoom or the phone. We love what we do, and the best part of what we do is connecting with people and helping you solve personal financial planning puzzles. So please don't hesitate to reach out. So without further ado, let's get rolling here. The obligatory disclaimer, this is for educational purposes. We're not giving specific tax advice during this presentation. Hopefully that's obvious, but it's important to point that out. We encourage everyone to consult with your tax advisor or your financial advisor for your own specific unique scenario. And for anyone who's listening to this on a recording, because we are recording this and it will be available for recording, please note that everything that we're talking about is as of the end of October 2021. And like we will talk about, a lot of this is evolving. Some of it could change by the time the recording is being listened to.
Hopefully not to affect 2021, but honestly, you never know. But we think 2021 is relatively safe at this point.
At this point, for sure. So here's just a quick outline and kind of the high level what we're going to cover today, going over some of the basics, right? Laying the groundwork for what hopefully everybody's familiar with, then on taxes, types of income, deductions, credits, spending some time on, hey, what are some strategies that may be applicable before year end, either this year, right, or looking into 2022, and I know a subject of interest for a lot of folks, and we got a few questions ahead of time, is just, hey, what the current sort of evolving situation with tax proposals, whether it be coming from the Biden administration or others here in Washington. So Alp, I'm going to turn it over to you here for the next.
Well, around DC, everybody is familiar that we file both federal and state income taxes, but what most people don't realize, there are 7 states that do not have state income taxes. So Jason, there you go. The benefits of 2 different panelists controlling, but there you go, perfect. 7 states that don't have a state income tax, and probably the stars of the show these days have been Florida and Texas. And the reason that has happened, because of the Tax Cut and Jobs Act in 2018, there's been a lot of businesses, and I'll say high net worth individuals, that have moved to either Florida or Texas because of the capping of writing off your state and local income taxes at $10,000. So one of the things I want to point out, though, if you've actually moved to a state or planning on moving to a state without a state income tax, in the year of the move, you'd have to file a part year return. But if you maintain property in a state that has a state income tax and later on you sell it, you likely will have a state tax obligation to that state. So for example, if you own a vacation home in Delaware and you've now become a Florida resident, when you sell it, Delaware will tax you on that. But what's really been fascinating about, I'll say, this surge of people moving south is real estate purchasing and just apartment rentals in those areas have gone through the roof. We heard a story of one apartment building down in Sarasota where when they've had turnover, when tenants have left, there's been such demand on it, they've been able to raise rents 100%. We find that fascinating. Clearly an indication that a lot of people have been moving to Florida or Texas. I know a lot of companies from California have moved over to Texas, the entire business, just to have less tax exposure.
And Nevada and others.
No
We
question.
love all the states here, listed here, but the big stars definitely have been Texas and Florida. They get a lot of the press.
Without a doubt. Without a doubt. So the types of income, generally two types of income: ordinary income and capital gains income. And with capital gains, there's qualified dividend income, and they are taxed differently. So ordinary income is taxed up to 37%, the highest current bracket. And that makes up, amongst other things, these are the main items: wages, interest income, dividend income, and I'll qualify a little bit of that later on the dividend income: business income, Social Security income, retirement income, rental profits, unemployment income. All of that will be taxed as ordinary income. And in simple terms, it's whatever tax bracket you're in, that's what you'll pay on it. So if you're in a high tax bracket and you get a $50,000 year-end bonus, that will get taxed at the high bracket you're in right now, if not moving to the next bracket. But when it comes to tax preference, in a sense, or lower tax rates, if you have qualified dividend income and capital gains income, that will actually get taxed from 0 to 23.8%. And some people will scratch their head and say, how do I get taxed at 0? If somebody is in a super low income tax bracket for a specific year, or they're in retirement and they haven't been taking RMDs, required minimum distributions, out of the retirement account, they might have a situation where they can actually take in qualified dividend income and capital gains income. And it's different for single versus married people, where they potentially would pay 0 tax on capital gains up to a certain limit, and the same thing, 0 tax on qualified dividend income up to a certain limit. Short-term capital gains are taxed as ordinary income, long-term from 0 to 23.8%. So there's basically a 15% and a 20% long-term capital gains tax bracket, unless your bracket is lower. But on top of that, there's actually a 3.8% surtax if your income is above a certain level, and it varies for different filing statuses. If your income is above a certain level, you'd pay this 3.8% surtax that was actually put in place to pay for the Affordable Care Act. But when you see this favorable tax treatment here, this is why people like Warren Buffett have made comments excuse me, have made comments that they are paying tax at a lower bracket than other people that work for their companies, just because for Mr. Warren Buffett, almost all of his income is dividend income or capital gain income. But
I'll mention those thresholds for the 0%. So for single filers, if your taxable income is below 40,400, and for married filing jointly, it's just double that, 80,800.
And that's taxable income.
Taxable income. Yep.
So at times there are, for people we've worked with in retirement, there's times we can actually take in some capital gains and not pay tax on it. That's a federal issue. You might still have to pay tax on your state tax return. When you hear the term tax brackets, we have a progressive system in our country. And so, for example, if somebody has $100,000 of taxable income and they're a single filer, the way it works is their $100,000 will hit 4 different tax brackets. basically the first 10,000 they'll pay 10% on, then between 10,000 and 40,000, I'm rounding here, they'll pay 12% on, and between 40 and 86, 22%, and the amount above 86, they'll pay 24%. So you can just see how progressive tax brackets work. We're only showing 2 filing statuses here. There's also married filing separately, head of household, qualifying widower. But just for examples, this is how it works. Fairly simple, fairly straightforward. When you hear people talk about they'd love to see a flat tax, generally what that would mean was that everybody would pay tax at the same rate. The odds of that happening, we'll kind of joke and say slim and none, but it generally gets talked about frequently.
Usually in conjunction with kind of eliminating all the many of the other kind of deductions, credits, all that sort of stuff.
Without a doubt. You hear the term the standard deduction or itemized deductions. The government gives everyone a free standard deduction, and what that means is if you're a single person and you have $100,000 of taxable wages, let's assume you have no other income, no dividends, no capital gains, and no write-offs, they'll basically give you a $12,550 deduction, which means that you will actually pay tax on $87,450. So depending on what your filing status is, you look at your taxable income and you'll figure out how much tax you pay, but everyone will either itemize or get a standard deduction. And one of the things we've noticed over the last 3 years now, that there's a lot of people that have homes paid off or very low mortgage balances on their homes that are now getting the standard deduction and not itemizing anymore.
And there you'll see there for folks 65 and older now and or blind, there's additional standard deduction amounts of around $1,350 to $1,700.
So when you hear the term itemizing deductions, these are the 6 main itemized deductions: medical expenses, state and local taxes, that's called the SALT limitation there, mortgage interest expense, investment interest expense, charitable contributions, and miscellaneous itemized deductions. Essentially, when it comes to itemizing, you add up all these deductions and you compare it to the standard deduction. We'll show you a slide that actually shows how that works, but I will go through all the itemized deductions one by one to kind of help you understand what they are. The first one is medical expenses. You can deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. In the years that I used to do tax work, it was generally rare for a high income individual to be able to exceed this 7.5% threshold. Usually it was substantial dental expenses that got them over that threshold. So, if somebody had $300,000 of income, they needed more than $22,500 of medical expenses, and it's unreimbursed medical expenses, to be able to deduct it. And we've seen dental bills that have gotten substantially above that. So it does happen. And generally medical expenses are anything that affects your body or your mind except cosmetic surgery. You can Google online what qualifies as medical expenses, but eye care, dental care, again, counseling, all of that will count as medical expenses, and you get to deduct whatever is unreimbursed as long as it exceeds 7.5% of your adjusted gross income, and you can still itemize.
And Alp, we had a question come into that point. Do premium payments for health insurance include?
Yes, yep. Premium payments do count with long-term care insurance. If you're working with an accountant, they will work with you on how that will be deducted. And sometimes some of those things can actually be deducted separately on a state income tax return when it comes to long-term care insurance as a separate thing over and above the medical expense deduction.
Quick sidebar, I know we had several folks sign in right after the start, but if you have questions at any point, feel free to type those in using the Q&A chat box. We'll keep an eye out for those and address those as we go.
And I'll throw in one last thing on medical expenses. If it's towards the end of the year and you've actually met the threshold, it's generally advisable to do other things that you wanted to get on. So if you had other dental work to do, you want to do it. If you're getting counseling, maybe you could prepay some of the items for 2022 if you think you'll be over the threshold for the year 2021. So there's a little bit of year-end planning that can go here.
Yep.
All right, so this was the biggest change in the 2018 tax law. So state and local taxes. That includes real estate taxes. It actually includes sales tax for some people that can actually write off some sales taxes, but it's capped at $10,000. And so if somebody's got real estate in a, I'll call it a high real estate tax area, that alone, we've seen numbers in New York that are $50,000, $75,000, $100,000 just for real estate taxes alone. All of that, if it's a personally owned property, this is not rental properties or business properties. If it's a personally owned property, basically all of those taxes, your state income tax, real estate tax, personal property tax for states that charge personal property tax, capped at $10,000. And we have a little asterisk there. And this came about, this has been worked on for a while, but there's actually been some workarounds in some of the states to get around this restriction. And I was talking to somebody probably 2 weeks ago that I know was a high income earner, and they have what's called a pass-through business entity in the state of Maryland. And Maryland is one of the states that worked on it. And basically, they're allowing people to write off state income taxes as, I'm going to call it, a business expense through your pass-through entity. And this person didn't take advantage of it in 2020 when it first came out, and was very surprised that his accountant didn't tell him that. And he's going to save a lot of money in 2021 by working on this. There's a process you have to go through to make this happen, but it really is a fascinating development. Some states I've talked to my old tax partner, Pat Flynn, where he said some states, I think he threw out California in particular, makes it very difficult to use this workaround. But again, not all states have adopted it, and some states have made it difficult. Maryland actually made it fairly straightforward.
Alp, we had another question come in, and I know this it's directly related to this, also jumping ahead a little bit to some of the proposed tax laws, but the question is, what's the latest we're seeing on the possibility of just at the federal level changing this, raising it, repealing it?
Yeah, I think that they would love to see, currently with the Democrats controlling things, they would love to see this change. But I think it is going to be somewhat difficult to make it happen. That's probably on one of the top items on their wish list, right? But I don't have a lot of confidence, and we'll get to something at the end where these things have been moving very quickly. But for now, just play with the rules we have, but hopefully it'll change.
Yep. Yeah, and as I think you alluded to earlier, right? This disproportionately impacted the sort of Democratic Party leaning states, right, that had higher state income taxes, state property taxes, like California, like New York.
Yeah, California, New York, Maryland, Illinois, Massachusetts, New Jersey,
DC,
all got hit relatively hard with this. Mortgage interest, it's still tax deductible, but they've actually put caps on it. So if anyone buys a property after December 16th of 2017, the cap now is $750,000 of debt. So if somebody buys a $2 million property and has a loan for $1.3 million, only the interest on attributable to $750,000 of the loan is tax deductible. If you own a home that you purchased before December 16th, 2017, you're allowed to write off up to $1 million of mortgage debt, but that's for if the debt existed before that time. You cannot refinance it to a higher level and take advantage of it. And they actually now track this on your year-end 1098 form that comes from the mortgage lender. You'll notice they've added a lot of new information on that. It'll show the acquisition date of either the property or the mortgage. And the government now has the ability to potentially track it. I know they've been given the information. The question is, have they updated their software to identify it yet? But these are the rules as they are now. Home equity lines are still tax deductible, but they have to be used to improve your main home. So if you're taking out a home equity line of credit and you're using it to pay off other debts or to pay for college, that wouldn't qualify, but that's also still part of that $750,000 or $1 million cap. So it's one of those things that it's very useful these days. I think one of the things we've commented on, we did this presentation for DC Bar a few weeks ago, and probably the most relevant comment these days is you need to have tax software. If you're trying to do some of this manually, because you've just done it manually your whole life, I would tell you it's virtually impossible right now. It would just take too long. All the accountants obviously know the rules, but if you're using TurboTax or the like, you just have to make sure you put in the proper information. It'll cap it properly.
If you're doing it manually, you must be a genius these
Yeah.
days.
Or you're making a lot of mistakes, without a doubt.
So one other question here, Albert, I think you sort of addressed it, but just to clarify, what if somebody has more than one home, both for personal use, not rentals, have mortgages on both properties?
It's basically capped together based off the rules. So if you had bought one property before 2017 and the second one after 2017, you want to make sure that you enter it in a fashion that you can maximize your tax deductions.
Yeah, but you can combine.
Correct.
But it's the combined limits of either 750 or a million, depending on the purchase date, like you explained.
Yes, and with real estate prices going up substantially, it really does. This cap
is impacting more and more people,
hindering a lot of people being able to write off their mortgage interest.
Yep.
Investment interest. So this is different than mortgage interest. If you borrow money to make investments, this is not, I'll call it rental properties. This is not if you've got a loan on a business and you're writing off the interest expense on your business, that's separate. But if you're, I'll say buying a lot somewhere, so it's an investment interest expense, so it's going to be possibly a lot you're holding for investment purposes. Or if you're margining your personal investment account, you can't margin retirement accounts, but if you say have $1 million in your investment account, you could actually borrow money on that account to buy additional securities within the account. That's considered margin interest. That's part of investment interest. It's actually tax deductible up to the amount of your investment income. So the software will identify what is investment income, and so you can offset it. If you have more investment expense than investment income, it will actually get carried over. Your software will track it for you automatically. Charitable contributions. Fairly straightforward, no real changes here, though I will say the rules have been very favorable for 2021. You can now write off in 2021 a substantial amount of charity. It used to be capped at a certain percent of your adjusted gross income for 2021, though. If somebody has $300,000 of taxable income, if they make a cash contribution, check, etc., credit card of $250,000, they can write it all off in 2021. If they give away appreciated securities, they're only allowed to write off up to 30% of AGI. So let's just say somebody had $300,000 of income and they donate $150,000 of appreciated securities and that have been held long-term. They would be capped and there would be a carryover on that. So there are certain restrictions. But the main charities that I used to see back in my tax days was just good old-fashioned cash, check, credit card, or payroll contributions. Payroll usually was United Way for government workers. Non-cash contributions, clothing, furniture, household items. I always thought people overstated the value of their clothing because
and their cars.
it's pretty worthless. Furniture, I thought at times, we could raise that because used furniture can sell and certain household items. It all depends on the condition. You should keep a detailed list of what you give away. If you're giving away something that's really nice, take a picture of it. If you're donating a car to charity now, the rules have changed on that. You want to double check it. You can't just make up the value of it. They will tag it, the car and limit your deduction to what it gets sold for by the charity. So you really got to be cautious on that.
Al, forgive me if you mentioned it. I was reading a question that came in. The special $300 deduction, even if you're taking the standard deduction, did you mention that?
I did not mention that. So when it comes to the standard deduction, you can now write off over, if you're taking the standard deduction, not itemizing, you can actually write off charitable contributions up to $300 in 2021. And I believe it's $600 if married filing joint.
That's my understanding. Yep. Yep. And then
That's been a new change over the last couple of years to
yeah, I think
encourage
last year
people
and
to
this year.
donate.
Yeah. So there was a question, I believe this is related to the mortgage interest. Would timeshares be included in this?
Sure. And actually, this is a good question. So thank you for asking it. Timeshares, and I would also say if you bought a boat that's got a bathroom and a bedroom, that would count. RVs, all of that would count also. So those count as second homes.
Great question.
It could be somebody's primary residence in that matter. I've had people in the past that have lived on boats.
Mm-hmm.
Miscellaneous itemized deductions basically eliminated through 2025, but I'll throw out except for gambling losses. And the reason that is actually really relevant right now, if you think about all of the new gambling apps in a lot of states that allow, betting on sports, and we know a lot of people have become, I won't say addicted to it, but a lot of people have become involved with it. And so if you get a 1099, you should be mindful. If you have gambling income, the organization, when you're doing it online legitimately, they will send you a 1099 to reflect the amount of your gambling income. And so you can write off your gambling losses. So you want to be able to track those, and you can write them off up to the extent of your gambling income. And so many years ago when I was doing tax work, I had somebody that won the lottery in the state of Maryland. And so they were getting paid out every single year for 20 years. They had gambling income. And so this person who was writing off his trips to Vegas and his losses every single year. So it was an interesting little I'll say fact that that we couldn't find anything. It was if it limited you to the year you actually won the lottery, but his payout came out over 20 years, and in that example, I think he was getting 64,000. It was before the lotteries got really big. He was getting 64,000 a year for 20 years.
So don't forget this if you're thinking about going, out in the professional poker playing circuit.
So when do you itemize? So in this example, we're showing somebody that's married filing jointly, and you look at all of your itemized deductions. So they have the SALT $10,000 cap, mortgage interest $10,000, charitable contributions of 2,500. Add it all up, that's 22,500. Compare that to the standard deduction of 25,100. In this example, the person would just take the standard deduction. I'm going to throw in one kind of however. If you're really close to it, this is where a good accountant, because they have to generally do this with a manual workaround, they have to click a little box in their software. But there are situations we see that you can force itemized deductions on the federal return, and it could benefit you on your state return. So for example, in this example, we're showing if somebody had $22,500 of deductions, if it would be beneficial for them to write it off on the state return, because on the state return, they will back out your state income taxes, but you can write off your real estate taxes, your mortgage interest, and your charitable contributions as itemized deductions in your state. If that can benefit you on your state return, you generally have to itemize on your federal return to itemize on your state return. Most states use the words must, meaning that you must itemize on your federal return to itemize on the state return. But this is complicated. I talk to Pat Flynn, my old tax partner, all the time, and he says he comes across this quite frequently. I think the next one is for a single filer. So in this example, we have somebody with 7,000 of SALT deduction, 8,000 of mortgage interest, 1,500 of charitable contributions for a total of 16,500. Their standard deduction would have been 12,550, so they would itemize. And so in theory, the benefit from itemizing is they get, in this example, almost an extra $4,000 of deductions. And so in the old days, without the SALT limit, people's itemized deductions were substantially above the standard deduction. So again, that cap really did put a limit on how many people can itemize.
And I want to address another question that came in related to a prior comment on the $300 deduction for standardized filers. Is it only for cash donations or for non-cash charity contributions? It is my understanding it is only for cash donations. I just did a quick Google to confirm that, and I'm seeing that same thing. So I believe, is my understanding, it is only for cash donations. to get that $300 deduction for standard filers. First, thanks for the questions.
So tax credits are different than tax deductions. Tax credits are a one-for-one reduction in your tax liability. So if somebody had $25,000 of federal tax liability and they had $5,000 of tax credits, that would reduce the amount of tax they pay by $5,000. And the new tax law has greatly enhanced the child tax credit. And so this is probably when we first came to the realization of like, yeah, this is like impossible for anybody to do manually. But these are the main tax credits. You'll see child tax credit, family tax credit, child dependent care credit, adoption tax credit, lifetime learning credit, American Opportunity Tax Credit. Those are education credits. Home related tax credits, and probably one that's getting a lot of attention these days is the EV tax credit. The EV tax credit is, I believe, up substantially in the recent law. I haven't seen that much stuff coming out from the accountants yet because they are being, I think, very cautious. They don't send it out because they haven't been sending out as much information as they used to, because I believe they're waiting to see what happens in the remainder of the year, and then they will send out basically all the new changes to the law. But the EV tax credit is basically going up to $12,500. It's by manufacturer. It depends on how much you spend on the car. Hybrid cars qualify for this, but if you spend a lot of money on an electric vehicle, the tax credit could be as high as $12,500, up from a $7,500 cap. However, there is a rule that says if the car manufacturer has sold more than, I believe it's 200,000 cars, they basically have exhausted their tax credit. And I think they were trying to get a workaround on that. And my understanding is it came back with it had to be a unionized auto company to qualify for that tax credit. And I believe the cars had to have been made in America also. And the Tesla shop is a non-union shop. So this was the Biden administration actually throwing a bone to the unions on this, which kind of caught us off guard. We thought it was strange. I believe we had a pre-question related to the home tax credits, Jason.
Yeah, around solar panels, potential deductions or credits on solar panels for your home.
Yeah, so for 2021, I believe that is a 26% federal tax credit. I will tell you, on a state-by-state basis, some states also provide tax credits for solar and other residential energy saving attachments to your home. Like if you're putting certain doors on, certain windows, there's certain things, insulation, that you can actually get tax credits on. So it's one of those things, if you're running through the tax software yourself and you see the tax credits, you want to make sure you answer the prompt questions to see if you qualify for any of them. It's really fascinating. I have a house that has, the prior owner, not me, put geothermal heating in it, and I had to replace a heat pump on it, and it turned out it qualified for a 26% tax credit on my federal return. And Maryland generously gave me $500 on it also, because it was a new unit attached to a geothermal unit. So it's fascinating when you look at some of these things on what you can actually get tax credits for. Again, the child tax credit, I think we'll go over it on a slide or two, but it is expanded greatly.
And if you are seriously considering solar panels, under the current law, I think it's set to, the credit is set to go down from 26 to 22% in 2023. So,
and it used to be 30%.
All right. Yeah, and a lot of the states have a similar kind of phasing out, or so if it's something you've been considering or looking at doing, you might want to just see what the pace of reduction of those credits that might incentivize.
Yeah, and I'll say, generally, anybody that's selling the solar panels or anybody that's selling the EV cars,
they're well versed on these credits.
Absolutely, right. If it's something that qualifies for a tax credit and it could actually get the sale done, they will let you know.
So actually, sorry, we had a question again on our earlier question around the charitable contribution rules. Our thoughts on whether those are going to change in 2022 with the new laws and process. So, we're touching on a lot of different things. I want to hear if you're seeing something different out, but I'm not seeing a lot of talk about changing the charitable contribution rules. There was, I think, you mentioned the temporary change this year for the cash contributions, right? The limit was taken off, right? You can deduct 100% of your income
of your AGI,
of your AGI with cash contributions.
And AGI, excuse me, is adjusted gross income. Sorry.
Yes, thank you. Yep. And that's set to go back to the prior rules of 50%. But that's not really a change going forward in our book. That's more of a 2021 had a special kind of carve out.
And I would say that they are always really careful here on charitable contributions. They're mindful that America is a very generous country and they don't want to take that away. I don't think anybody wants to be responsible for taking away the tax deductibility of charitable contributions. Any other questions?
No, I think we're up to date. Thanks.
So the child credits up to $3,000, $250 monthly per qualifying dependent child. So if you've got a lot of kids, this is a lot of credit. And I believe one of the major changes on this is now refundable tax credits. And the big difference when it's a refundable tax credit, it means you can actually wipe out more than the tax you paid into the system. So for example, if somebody had 6 kids and they qualify for, $18,000 of tax credits and only paid in $15,000 to the system, my understanding now is they will get the full $18,000 credit and essentially get their 15 back plus an additional 3. Right. So really a big change. You can see for different ages and you can see the phase outs, but for, large families with incomes below certain levels, and you can see again, there'll be a phase out between these 2 periods, but really the credits are substantial. One thing that's a little confusing, they have prepaid some of the credits in 2021. And so you'll be asked to reconcile it on your tax return. And my guess is this potentially will hold up some returns because some people will say that they didn't get the credit that actually might have received the credit, or the feds think they sent the credit out somehow, but maybe a bank account had changed and it was not getting deposited into the right bank account. So this could be a confusing area. And again, why it really makes sense to use tax software and just make sure you look through your records on it. Family tax credit. This is for kids or dependents that do not qualify for the child tax credit. Phase outs on it also, but again, the tax software will do it for you automatically. You should get a commission from TurboTax here. Student loan interest deduction. There's some low phase outs on it, but if you qualify, you can write off up to $2,500 of the interest on your student loan payments. So an easy above the line tax deduction, so you don't have to itemize to write off student loan interest. It actually gets done on what I'll call the front page of your tax return. So it's before itemized deductions.
The good kind, right?
That is it. Over to you, Jason.
You bet. Yeah. So health savings accounts, one of my favorite tools for saving money, saving on taxes. These have definitely become more and more popular over the years. And we have an entirely separate presentation just on health savings accounts. So we're going to gloss over it here pretty quickly, but recognize that if you want to learn more, reach out, or we have a whole nother presentation that we have recorded. So the idea being, most importantly, if you are eligible, right? And to be eligible for a health savings account, you need to be enrolled in a high deductible health plan. And there are IRS rules that say the deductible needs to meet certain limits. You can do it as an individual or as a couple or as a family. But from the tax perspective, these are triple tax free in that you get a deduction for contributing to a health savings account, right? Similar to putting money into a pre-tax 401k or IRA. While the money is inside the health savings account, if you're earning interest or some accounts that you invest the money, the growth is all tax deferred, again, similar to like a traditional IRA or 401k. And then the triple tax component of it, all of those contributions and earnings can come out totally tax-free, so long as you're using the money for qualified medical expenses. And here you'll see there on the slide the contribution limits. So if your whole family is enrolled in a high deductible health plan, you can put in and deduct up to $7,200 plus a catch-up contribution of an additional $1,000 for folks ages 55 and older. And one of the other cool things about HSAs is that once you get past age 65, if for whatever reason you say, you know what, I've accumulated a good balance in my HSA and I want to pull some out to just supplement my retirement, right? I don't necessarily need it for health related expenses. It can be a supplemental retirement account and you can pull it out and pay for non-medical related expenses, but you'll just pay tax on the earnings, or excuse me, on the entire distribution, just similar to like an IRA. So really great tax savings tool for those of you who are eligible. Just one other quick comment there is a lot of folks may be enrolled through their employer and have payroll deductions coming out from your payroll, and maybe some employers also contribute to it for you. So these limits, these contribution limits are combined, what you put in and what the employer puts in. But keep in mind that if you get to the end of the year, and let's just say you're a single person and at the end of the year, $3,000 combined got put into the HSA, you still have the ability to bring it up to that limit. If you've got another $600, put it in, and you have up until your tax filing deadline to put in the 600 and then write it off on the tax return.
And Jason, question for you.
Yeah.
What about for people that are on Medicare? Do they qualify for high deductible health plans?
Yeah, great question. Once you are enrolled in Medicare, Medicare is by definition not a high deductible health insurance plan. So you're no longer eligible to contribute to an HSA. But a really important thing to remember is HSAs are not like the old-fashioned FSAs where it's use it or lose it. HSAs are yours forever. So even if you've got an HSA balance and then you enroll in Medicare, even though you might not be able to contribute to the HSA anymore, the HSA money that you already have is yours, and you can use it to help pay premiums, to help pay out-of-pocket expenses, even to help pay long-term care insurance premiums or related expenses. So
yeah, and one of the things that we've seen over the years is for families that can afford it, or individuals that can afford it, they will not pay for anything out of their HSA. They will let it grow forever. So if they've got the cash to pay for everything out of pocket in addition to funding the HSA, they will do that and let this grow basically for the latter part of their life, when typically the medical bills are substantially higher. And as I mentioned, we've had people in their 60s that have had 60s, 70s and above that have had $50,000 dental bills. And so that's a great time to start using the HSA. Right?
And had a question: can you use your HSA funds to pay for a supplemental medical, I'm guessing medical policy if you're on Medicare? So
some things qualified. I think,
yeah. Go ahead, Al.
We went through this a number of times. There are restrictions on it. I don't remember exactly what they are, but certain policies will qualify, but not all policies.
Yeah, so, and we can confirm that for you. But yeah, like Alp said, I get my head turned around on some of these things, and that's one of them. There were, yes, some of the premiums you can pay premiums out of the HSA and it qualifies. And I don't think the supplemental.
I know it's a really easy Google search.
Yeah.
I mean, because we picked it up off of Google search, and you'll see 4 or 5 of the HSA vendors that will show you the rules and how it applies.
So just to some of the basics, right? And one of the common questions that we'll get working with folks is to say, hey, I'm trying to figure out how to reduce my tax burden, right? How can I lower my taxable income? And the first question that we'll often come back with is, well, are you maximizing your retirement savings plans, right? So are you putting in the maximum into a 401k or a 403b or an IRA if you're eligible? And so there's the 2021 contribution limits, depending on if you're under age 50 or age 50 or over, right? So this is like the real simple stuff, right? If you're looking to lower your tax burden and you can afford it cash flow wise, get money into the pre-tax IRA, 401k, 403bs. Something else that we often talk about is, okay, to Roth or not, right? So as hopefully many of you know, if you contribute to a Roth, whether it be just the Roth IRA or a Roth 401k plan, you do not get the deduction for the contribution, but that money someday when you pull it out will come out tax-free. And then what a strategy that's become more popular over the years is something called a Roth conversion. And I know we had some questions around that ahead of time. And basically the idea there, and let me jump ahead here, is, okay, you've got money in a pre-tax IRA or 401k. I'm just going to pick on IRA for the moment because that's typically you will convert from a pre-tax IRA to a Roth, right? And so what does that mean? It means you're taking money that has never been taxed, right? You contributed, you got a tax deduction for the contribution, it's been deferred inside that IRA. Now you're saying, I want to get it into a Roth because the Roth, once it's in the Roth, can grow totally tax-free from that point forward and come out totally tax-free, both in your lifetime and if you're thinking about the next generation. And we have folks that are kind of saving as part of their legacy planning. And then what's sort of one of the best kind of assets to leave to the next generation is a Roth IRA, because when they draw it out, they won't pay any tax on it. And so, but the catch, of course, is when you convert it, the money you move out of the pre-tax IRA will be taxable in the year of the conversion, right? So it just gets added to your ordinary income. And here's where a lot of times it's sort of that annual tax planning where, gosh, if something changes in 2021, right, or in 2022, where let's just say you moved to a state with no state income tax, or you had really large medical expenses, deductible medical expenses that Al talked about, or you've retired and you no longer have income from work, you're not yet age 72 and drawing required minimum distributions, maybe you haven't yet turned on your Social Security, so you're in this window of really low taxable income. Those are all kind of the examples of scenarios where, oh, you know what, I can get some money out of the pre-tax IRA, pay low taxes on it, get it into the Roth, and have that grow totally tax-free thereafter. I know one of the other things, I think it's right on the tip of Alp's tongue, he's about to say it, is if there's a big market pullback, right? If there's a big sell-off in the market, your IRA balance is temporarily down, that can be also a time to consider, oh, you know what, let's convert while things are beat up, get that money into the Roth, so that then the recovery happens inside the Roth wrapper.
Again, you can do any amount you want. So, if somebody's got that $1 million IRA, if they wanted to convert $100,000 at a time, $50,000 at a time, they can do it. It's taxable income. For those that are paying for Medicare premiums right now, one of the things to be mindful of is if you do a Roth conversion, it will impact your Medicare premiums because they will look back at that at some point. I think they're generally 2 years behind in determining what your Medicare premiums are. So if you do a Roth conversion in 2021, they will potentially raise your Medicare premiums in 2023.
Another important variable to keep track of. I had a question here. Can you add to your IRA/401k to max it out in the year you retired, even if you are currently not working?
I guess.
So I guess I'm going to split that sort of into two. If you're no longer working, typically you're no longer eligible or a participant in the plan, thus wouldn't be eligible to contribute to it. If you're going to retire mid-year, and maybe the question is, hey, I would like to get in the full 26,000 into the plan, but I'm only working the first half of the year. Most plans will allow you to accelerate and defer maybe 70-80% of your paycheck to get the that maximum into the plan before you are no longer eligible. So hopefully that answers the question.
And I know, Jason, talking to Alex on the 401k team, the mega backdoor Roth, which is available in some 401k platforms. There's a way you can actually put substantial money into a Roth in, I'll say, certain 401k platforms. Company has to sign up for it. But my understanding is that is back in some of the proposals to be on the chopping block. And so we think we're safe in 2021. I believe Alex and the team are watching this carefully and will let everybody know if it has any impact on 2022. So there's a lot going on out there.
Going on. And speaking of a lot going on, we're getting down here to the last 10 minutes, so we want to pick up this pace a little bit. So just quick comment that potentially can get state tax deductions for contributions to 529s, whether it be for you, a child, a niece and nephew, a grandchild. That a lot of states, including the 3 listed here, all have. If you are a resident of that state and you contribute to that state's plan, you can get a state tax deduction. A great way of making charitable gifts. Talked about this a little bit before, but just kind of as a quick recap, let's just say you're thinking about making a $5,000 gift to your favorite charity before the end of the year. You typically, charge it to your credit card or write a check, but maybe you've got some. Actually, I was just talking to somebody yesterday who bought some Tesla stock, many years ago at really low cost basis on it, and had an overweight position there, wanted to diversify out of Tesla, but didn't want to pay the capital gains of selling it. But they know they wanted to give to this charity. Well, rather than writing a check to the charity, they're going to transfer a few shares of Tesla to the charity. The charity then sells it tax-free because they are a tax-exempt organization. And presuming that the donor itemizes, the donor gets the same value in terms of the deduction as if they had written a check. So it can be a really great kind of win-win all the way around.
What's the value of the shares on the day of the gift?
On the day
There's
of the
a
gift.
formula for how you actually figure out the amount that's tax deductible. It's shares that are held long-term, not short-term, and you get a tax deduction. If you do a lot of this, we talked about earlier, appreciated securities can be restricted of a percentage of your adjusted gross income at 30%. But I'll also point out that last line, the charities sell it. You don't sell it beforehand yourself and hand them the check.
No,
you actually have the shares transferred to the charity's account.
Yep. And most every charity has, it's simple. They'll have a brokerage account set up, and you'll just work with them to find out that account information to transfer the shares.
This is personally held shares, not retirement shares. Not
yes, not no
accounts.
retirement account, right? Yep. So donor advised funds, another tool that's become more and more popular in recent years. Kind of think of like the old family foundation scenario, but at a much sort of lower cost, simpler version of that. And again, there's a lot of information here, but thinking about it in terms of kind of like year-end tax planning. So where this really comes into play is someone, kind of to the earlier question, hey, if someone's getting close to retirement, maybe you're going to retire at the end of 2021. I was actually just having a call with somebody the other day on this very scenario, where it looks like this is going to be their last year of high taxable income, right? Because after this, they're full stop retirement, not yet RMD age for distributions from the IRA, not yet going to start Social Security, but they know they want to continue giving to charity into the future. So going to open up a donor advised fund in their name, could contribute. You can contribute cash or appreciated securities, just like we talked about on the prior slide. Your personal donor advised fund now is the tax exempt charity, so you can donate. Maybe you say, you know what, I want to front load 5-10 years worth of my next 10 years of charitable giving into the donor advised fund now to get the deduction in 2021 against your high taxable income, and then inside the donor advised fund, the shares that you've donated, you can sell, no cap gains once they're inside the donor advised fund, and you control how much and when you send them out to the charities. There's no deadline.
And also under current law.
Under current rules, yeah, that is something that's been talked about, but currently there's no deadline and no requirement that you have to send out a minimum amount each year. Depending on the donor advised fund that you set up, a lot of times they'll just have a minimum that say, hey, they don't want to be doing a lot of like the $25 kind of distributions out of the DAF. Some of them are like around $250, but that's just kind of an administrative minimum for sending money out of the donor advised fund.
And the donor advised funds actually take the effort to confirm that it's a qualified charitable organization that the money is going to. So, they will make sure it's a 501c3.
So here's just a quick example that I just walked through. I guess I should have clicked here when I was talking about it, right? So tax year 2021, you can contribute $30,000 of cash or appreciated securities into the donor advised fund, and then distribute them out at your leisure, right? Based on your your normal giving pattern.
And this is a great tool for people that give a lot to charity, generally each year, but they can't itemize because they don't get above the standard deduction. So you'll see some people lump together. So if they do $10,000 a year, like this particular example, they'll lump together 30,000 all at once into the donor advised fund. They'll be able to itemize in 2021, and they can then give the money out in 2021, 2022, and 2023. Again, they already got the deduction in 2021, and they'll take the standard deduction in 2022 and 2023.
All right. Yep. Just hopefully stating the obvious. You do not get an additional deduction when you send it out of the donor advised fund. So another great way of tax efficient giving to charity, if you are subject to required minimum distributions, rather than receiving it and having it be fully taxable to you, the IRS has a carve out that says you can defer up to $100,000 of a required minimum distribution and have if you send it directly to a charity. So what happens kind of technically is, let's just say somebody has a $50,000 RMD, and they say, I want to send $20,000 to charity. So you work with us or the institution where your retirement account is, and say, all right, please send $20,000 of my distribution to said charity. And then at the end of before the end of the year, you take your remaining $30,000 out as a normal distribution for yourself. So you've met your required minimum distribution, and you'll get a 1099 that says, hey, the full $50,000 came out. But then when you do your taxes, make sure, if this is your first year doing a QCD or qualified charitable distribution, you have a note that says, you know what, of the 50,000, 20 of it went to charity, because on the return, you'll note that, hey, I had a $50,000 RMD, but only 30 of it was taxable to you. And so
you don't write off the 20,000 as a charitable contribution.
That's right. That's right.
But go ahead, Jason. Sorry.
Yep. No, it's a great point. It's not an additional deduction. It's just not. It's a way of reducing your taxable income. So it's a great example for folks who are not itemizing, right? If you're just taking the standard deduction and you wanted to give to charity, and you normally would have written checks or given appreciated securities, but you're saying, but I don't really give enough to itemize. Oh, you know what? Why don't I just send them some of my RMD via a qualified charitable distribution, and it will reduce your taxable income.
It's pretty straightforward how it works. On the tax return, you'll get a 1099, and it'll list the gross distribution. So it gets input as the gross distribution. So in that example, 50,000, but it'll also ask what the taxable amount of the distribution is. And so it would put 30,000 because you gave 20 to charity. So it actually gets identified to the IRS 50,000, but only 30 being taxable.
Yep. So just here in the last few, common question we get is, well, how much can I give away to someone without having to file a gift tax return? Well, 15,000 is kind of the magic number for any individual. So we could all give to as many people as we want, $15,000 per year. Or if you're a married couple, right, as a combined, you could give 30,000 per year. No one pays any tax on that gift. And even if you give more than 15 or more than 30 in this example, no one pays any tax. Okay, so
as the recipient,
as the recipient or as the giver, right? There's no taxes paid. What happens is, if you do give to any one person above $15,000, let's just say you gave somebody $100,000, the 85 above the 15 threshold just is an accounting. So there's a gift tax return that gets filed with your annual return that just says that you used 85,000 of your lifetime exemption, right? And so it's a combined exemption of giving while you're alive, and via estate, right, your legacy giving after you're gone someday. So under current rules, and this is something that that is talked about, how is it going to change, but currently an individual can give about $11.7 million. It was a significant increase back in 2018, set to sunset in 2025. So you could give up to $11.7 million, and no one pays any tax on it. You just account for it on your using of your exemption. All right, so here I think we're down to the last.
And this is changing next year, Jason? 15,000 is going to 16.
15,000 is going to 16. Yeah, it's been level at 15 for several years, but it's going up in 2022 to 16. So I know some folks say, you know what, I want to help one of my kids, to buy a house, and I wanted to give them, $50,000 before the end of the year. You might just to kind of keep things simple, we'll give them 15 now, right, and make till January, and give the additional amounts. And if you're married, you can both do it, right, to just avoid having to file the estate tax return.
So year-end tax strategy ideas, we've talked about the 401k 403b, trying to catch up if you have not already maxed out for the year. Something that I always do every year is prepay my mortgage. So I always pay the January payments early in December. And I say early because you want to make sure that they receive the payment. These days with online banking, it's pretty easy to have them receive it almost immediately, but you just want to make sure you pay it early enough so it actually gets registered by the lender that was paid in 2021. You always have to remember to do that every year from that point forward, because then in theory, you'd only have 11 payments if you forgot to do it at the end of the following year. Roth conversions, if you're going to be in a low tax bracket, Jason talked about that. It's always something worth considering and really valuable for people that are in states without state income taxes. I think it's even more advantageous for them. And one thing I don't think Jason said is if your kids then inherit your Roth at some point and they live in a state with a state income tax, it's kind of irrelevant because it's inside of a Roth, so there's no state taxes for them. So it's very, very beneficial. Year-end charitable giving. This is probably the time of the year when the phones at the charities are really ringing off the hook, or the online contributions are just really piling up. We talked about the 529 contributions. We talked about gifting. Tax loss selling. If you've got losses in your non-retirement accounts, and if it's a position that you don't like, you can actually sell it. And actually have to be out of it for 30 days. There's something called the wash sale rule. So you can buy it back if you really like the position after you go through the wash sale period, but that's something that we generally take care of automatically. Fund your IRA, SEP IRAs by the due date of the tax return. We talked about the HSA contributions by the due date of the tax return also. Any additional ones? This is always something for people that have businesses or people that have the ability to take bonuses in different years. So if you have flexibility, if your employer gives you the flexibility, you have to always make a decision. Will I be in a lower bracket in the next year? So sometimes we're dealing with some people with in sales that might have super high incomes and they're in the highest tax bracket in 2021, but they know that they won't have as successful of a year in 2022. So if they can get bonuses or the last commission checks paid out in 2022, very advantageous for them. Other things you can do is accelerate deductions. So if you've got the ability to prepay things, we talked about, if you had medical expenses and you thought they could be deductible, you could do that. Accelerating charitable contributions. If you've got a real estate tax bill due in March of 2022, can you pay it in 2021? And there's been some, at times they worry about that you have to make sure you can still get it. You weren't already up to the SALT tax limit, but I'll just say work with that one on the account to make sure you don't make a mistake on it. But there's things you can accelerate. There's things you can defer. What you're really trying to do there is balance out your tax brackets, trying to make sure that you're doing it in a way that makes sense financially and tax bracket wise. The Biden tax proposals, probably the best way to describe it, and we've hinted on this a little bit already, they're very fluid. There is no question that there's a lot of talk out there, specifically for people that make above $400,000. So far, the Biden administration has commented over and over again, they're trying not to impact anybody that makes less than $400,000. So any of the higher taxes are for 400 and up, and they've had some proposals that are substantially higher income, that just hitting people at 10 million, at 25 million. So a lot of different things out there, but this area is very fluid. Stay tuned. I think there is some things that will change. However, again, it's got to make it through the Senate. And I think we've had a few holdouts in the Senate that do not want to raise taxes, especially if it impacts their districts. They're just being very mindful. They also don't want to raise spending in a year or after a couple of years when we've had just massive deficits. So There's a lot going on here.
Alp, we have one more question here related to backdoor Roth contributions. So if the law changes after 1/1/22, so in the new year, do you recommend still making a backdoor Roth contribution in 2022, or wait for the law to be finalized?
So let's just say they no longer allow the backdoor Roth in 2022. If you have, I'll call it a zero balance IRA, because you've actually been doing the backdoor Roth and converting all along, I would actually tell you just keep funding the non-deductible IRA, and that way you'll build up basis in it. So for example, if you funded for 5 years and you've built up a $30,000 basis inside of your non-deductible IRA, you can then, I'll say, hope that the law changes and you can actually convert it. So who knows what's going to happen on that, but I think I would continue to do it. I think the work related mega backdoor Roth, that is the one that I think you have to be very, cautious on.
Well, thank you, everybody. Appreciate you joining us today. Apologize for running over, but hopefully you found this helpful, got some good information. So that's a wrap on this year's monthly workshop series. We'll be back in January. We'll be doing a market recap and outlook for 2022. So please reach out to us directly if you have questions, comments. Always appreciate feedback regarding the presentations. And yeah, let's double check our questions before we finish it up. Yeah, thank you for the kind words. Oh, you know what? I did miss a question here regarding HSAs. What if your employer doesn't have an HSA? How do you find different HSA options? Yes. Thank you. Yeah, so you don't have to, it doesn't have to be offered through an employer. You can set it up on your own so long as you are enrolled in a high deductible health plan. That's how I've done it in the past. I just opened my own HSA account. There are a number of different carriers out there. HSAbank.com is one example, but there are any number of HSA providers.
And it is pro rata. So if you were not in an HSA for the entire year, so you could only fund it for half the year then. So the limits get cut pro rata.
Yep, great point. So yeah, if you're enrolled in a high deductible health plan, I'm a big fan. Sign up and you can still fund it for 2021 up until your taxes are due. So here's our team, here's our contact info. Thanks everybody. Have a great rest of the day. Hopefully you can get outside, enjoy this,
and happy
beautiful
Thanksgiving.
Day. Yeah, happy Thanksgiving. Take care. Goodbye.